Hey guys, welcome to yet another lesson of accounting. Today we are looking at manufacturing. This is not a new topic in grade 12, it is also done in grade 11, but you're going to do it again. But you're going to do it a little bit more faster, and I need you guys to also check out the other videos we did when answering the past papers, because that's the most important part in order to be able to do past papers. Then you know that you understand topic. But here, just giving you a brief overview that is required for your normal understanding and the way you need to approach this topic. So without wasting any more time, let us jump straight into this. So let's start with the learning objectives. So the first learning objective is to understand the manufacturing process. The second learning objective is to be able to understand the costs involved in the production costs. And then thirdly, you should be able to differentiate between the prime cost and the factory overhead cost. And then you should also be able to differentiate between fixed and variable cost. And last but not least, you should be able to calculate and analyze the break-even point. All right, let's get into it. So what is manufacturing? So manufacturing is basically making goods from start to finish. The start is basically different for anyone. If you're someone that's making cake, maybe sugar is your raw materials. But if you're someone that's making sugar, then cane is your raw material. So you start from cane to sugar if you're making sugar. But if you're making cake, you'd start from baking flour and all the other materials that you use to make cake. I'm not really good at cooking. Um, and then the manufacturing process includes taking raw materials and converting them into semi-finished and finished goods. So the finished goods would be the goods that are ready to sell, and then the semi-finished goods would be the goods that are a work in progress. So you can see there by that presentation that we take goods from raw materials, put them into work process, and then after that we are able to get finished goods. So the costs involved in making these products, we have costs that are direct, and we also have the costs that are indirect. And if you add these together, you get the total cost of production. So the first side, which is the direct materials. So these are materials directly involved in making the product. You can trace them in the product. It's like if you make a jersey with wool, then you see the wool that is in the product. So that would be the raw material for manufacturing the jerseys. And then direct labor, these are the workers directly involved in making the product, e.g. the person sewing the logo. So I mean, yeah, so someone that's sewing the wool, then they are the ones that are actually hands-on. If you're manufacturing a table, the people that have the table and putting on nails and actually getting their hands in. So that would be the direct labor. And then the direct material plus the direct labor is equal to prime cost. And then we go and look at indirect costs. So at first we have the indirect materials. So these are the materials used in the factory, but not in the manufacturing process. Um, so you use them in the factory, but not in the manufacturing process. So you can think of things like cleaning supplies. The factory has to be cleaned, but the cleaning supply do not produce jerseys. You can think also maybe gloves. So if your workers have to wear gloves at work, the gloves are not raw materials. They do not go into the product, but they are somewhat related, but indirectly to the product. And then following that is the indirect labor. So these are the workers in the factory, but they are not making the product. So the key thing is that these people have to work in a factory. If you're a cleaner and you're cleaning the office department and you're not cleaning the factory, then it would not be indirect labor because it's not in the factory. So it has to be the work that is being done in the factory in order to fall under the indirect costs. And then lastly is all other costs to keep factory operational, but not necessarily for manufacturing. So things like rent, you have to pay rent, but rent does not produce goods. Electricity, you have to use electricity in the factory, but electricity does not make goods. Insurance does not make goods, but it is necessary to have a functional operational factory. All right. And then moving on to your production cost statement, this is what it looks like. This is a very common question that they ask you to prepare a production cost statement. You would start with the direct material cost, which is sometimes also called the raw material cost, and then you'd add labor, then you'd get prime cost. Then after getting prime cost, you would then add factory overhead, and then after adding prime cost plus factory overhead cost, you get the total cost of production. And if you have work in progress at the beginning of the year, you would add that, and then you then subtract the work in progress at the end of the year. And after that, you then get cost of finished goods. Sometimes you will be lucky enough that they won't have any stock of work in progress, whether at the beginning or at the end of the year. Make sure you look out for those and grab those marks. Moving on. So the next thing that we need to do is to be able to understand fixed and variable costs. Fixed costs are costs that do not vary with the level of production. It does not mean that they never change. They can change, but the reason for the change would not be because we have increased production or we have decreased production. That's what it is. So if we are renting a warehouse and we're using it as a factory, regardless of whether we produce 10,000 units or 2,000 units, we are still paying the same amount of rent. Does not mean that the landlord would not come and ask for an increase at some point in time, but the reason for the increase would not be related to how much you produce, but rather how much the property is worth. So that would be the case, whereas variable costs on the other side, they change with the level of production. So every time you increase production or decrease production, they will also increase or decrease. So for instance, if you need 2 eggs to make cake, to make 1 cake, then to make 2 cakes, you're gonna need 4. To make 3 cakes, you're gonna need 6. So every time you produce, the costs keep on increasing, and if you decide to reduce production, then the cost will also decrease. Direct material costs, that will typically be variable costs. In fact, most of the time, if in question papers, it's all the time. So, the direct materials, those are the costs that are involved, like the cost of the wool, the cost of the steel when producing a car. As you produce more cars, the more steel you have to buy. So that they will be variable. The indirect costs, at sometimes they tend to be fixed. It's not always, but they will most likely be fixed. And then non-factory costs include selling and distribution. It will generally be variable because people that are in selling and distribution are usually paid in commission, that if you sell so much, then you can make so much. So it is variable in that sense. And also administration cost, it will be fixed on the other side, because the people in administration, they don't really care how much is produced. They just do the admin and they get a fixed salary. That's just how it goes with them. So it's nice to be them. And then the total cost, now I'm saying the total cost for the entire factory, not just the total cost of production. The total cost would be the fixed cost plus the variable cost. So this is what, if I would put them in a graph, would look like. So you can see the fixed cost is at the same level regardless of the number of units. So you can see firstly the y-axis is the price or the cost to produce, and then the x-axis is the units. So you see here, as the units increase, the fixed cost is the same. Even at 0, you still have to pay the fixed cost. So if you're renting a factory and then you decide that month, well, I'm not going to produce this month, I just want to chill. Well, guess what? You still have to pay rent, you still have to pay insurance, you still have to pay some expenses that do not have to do and that are unrelated to the product, that are fixed regardless of how much you produce. So that's the fixed cost. You can see it's at the same level throughout. And then the variable cost, you can see the variable cost at when you're not producing, you're not incurring any variable cost. If you're not making any jersey, then you don't buy any wool, right? So that's the variable cost. And then the total cost is basically fixed cost plus variable cost. So you can see at the level of production of zero, the total cost is equal to fixed costs. And then you can see they go parallel because you keep adding that fixed costs over there. And then what I didn't present here is the cost per unit. I would have done so if I had the numbers, but you can already see here that fixed cost per unit reduces as you increase the units because you keep dividing the same number by a bigger number, so it would increase over time. And then let's analyze and try and understand what break-even point is. So break-even point is the level of sales where the business is neither making a profit or a loss. So it means that the profit is zero and the loss is zero. And we're gonna try and understand this using this example right here that we have. So here we have the cost, the direct materials, it's variable, and we have a total cost of 120,000. And we're told there at the last line that 5,000 units were produced. So you'd say 120,000 divided by 5,000 would give us 24. Direct labor, 90,000 variable. Then you divide that by 5,000, it gives you 18. Factory overhead, I said it is fixed. 80,000 divided by 80,000 divided by 5,000, 16. Selling and distribution, I said it's variable. Divided by 5,000 gives you 12, and then administration fixed 85,000 divided by 5,000, 17. Factory overhead, sometimes what they will do, they will tell you that 80% of it is fixed. And then you would take, and then you'd separate it. But in this case, I just said all of it is fixed. And then what I want us to do from here is that I want us to get to the point where we are able to calculate the break-even point and also present it in something like a graph like this. Let's see how it goes. So you can see the break-even point there. I've highlighted it. Break-even point is where this is the total cost column, and this is the total cost line. So the green line is the total cost, and then the revenue. The revenue one is navy. So you can see what they made. The total cost is equal to total revenue. This is the break-even point. That is the break-even point. So you know, for instance, here we said you produce 5,000 units. You sold each for 100 rand per unit. So if we produced, so if, when we made zero, obviously the revenue would be zero. But as we sell more, we getting income. But you can see here, for example, if we sell 1,000, well, 1,000 units is still below the total cost. So on these levels until here, we're making losses because we're not making above cost. And then here we make zero, and above here, we're making a profit. So if you're selling above break-even point, you're making a profit. And if you're selling below the break-even point, you're making a loss. And you can see here, this is the fixed cost. And then this is the total cost. And then the other line is the variable cost. You can see it's also parallel to the total cost. Right. And then just to put it into a calculation, because they don't really ask the graph, but I just wanted you to have an understanding of what the break-even point actually is in a graph. In a graph. So to calculate the break-even point, the formula is total fixed cost divided by selling price per unit minus variable cost per unit. The total fixed costs, obviously, we had two fixed costs, which was 80,000 and 85,000 for administration and factory overhead. So there was 156,000. And then the variable cost per unit, we're going to take 24 Rand plus 18 Rand plus 12 Rand. and that would be 54. And then selling price per unit was given here because we said 5,000 units were produced and sold for 100 Rand per unit. So 100, so selling price is 100, and then we take this 165 total fixed cost and divide by 100 Rand, which is the selling price per unit, minus 54, which is the variable cost per unit, and then we get 3,586.9565. And what we do when we calculate the break-even point is that we always round up. So even if it was 3.4.3, we'd still just round it up to say 3,587 units, and that would give us our break-even point. So it means that when we're selling 3,508 units, we are neither making a profit or making a loss. And then if we sell above 3,587 units, then that is at the point that you are actually starting to make profit. And if you sell below 3,587, then you are making a loss. So that's how it works with the break even. And that brings us to the end of our lesson. Hope you guys enjoyed it, and I'll see you on the next one. Cheers.